It is Wednesday, October the 24th, 2018. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates global risk. Therefore, the slides this morning will focus on our other three report areas of our monthly report: macro, regional, and U.S. economic developments. Specifically, I'd like to discuss developments in China. Shown here is the agenda I plan to cover in this session. My hope is to leave you with the following messages. China has now been forced to reverse its deleveraging and credit tightening efforts. We are beginning to witness an almost desperate effort by China to maintain its GDP growth through 1. Accelerating growth in hidden local government debt, 2. Stock market interference as stock pledging margin calls begin to ignite problems, and 3. Corporate debt defaults and lending issues from zombie corporations and poorly run SOEs, that is, state-owned enterprises, prompting corporate bond funding. China is most urgently facing an acute capital formation problem. Consumer wealth and wealth growth is too low, and the export-import dynamic has insufficient value add. You should expect China's credit expansion to once again accelerate, and that near-term globalization is presently at stake, and that we have reached the final stages of the globalization trap. In our April Under the Lens video, we delved into China from a perspective of the size and growth of corporate debt, the reality that China's 150,000 state-owned enterprises and their impact, the dominance of state-owned and controlled bank lending. 7 months after this video, we see that the latest Chinese economic statistics are at the lowest in 10 years. Real GDP is just 6.5% in Q3 2018. It's the slowest pace since the first quarter of 2009. That's not good, especially for a statistic of such dubious practices, often specifically crafted to be the best it can be. What that suggests is that we are likely not going to witness an immediate catastrophic failure, rather offering instead a more complete confirmation that this major global economy is slowing. This is significant, and what is significant about it, there is no longer upside, but rather a steady downside driver to the global economy. Nominal GDP, perhaps a more appropriate measure of China's economic conditions, decelerating yet again in Q3. Year over year, it rose just 9.6%, down from 9.8% in Q2, and a peak of 11.7% set way back in Q1 2017. These numbers may sound great in comparison to the U.S., but as you will see in a moment, it is about what makes up China's GDP. Across the board, whether industrial production or retail sales, economic conditions are steadily deteriorating. The news and economic surprises are increasingly negative. The real danger presented by these statistics is not an imminent crash, as I said, but rather, most importantly, is the total disappearance of any upside potential. Even during 2017, the narrative about global synchronized growth continued as a future property. The global economy in that year was clearly better than it was during the worldwide downturn in 2015-16. Easy comparisons, and that was expected only as the first step towards meaningful acceleration and then recovery. Where economists and central bankers jumped the gun was in assuming that 2017's improvement was the only evidence they needed to complete their expectations. As it turned out, as it always turns out, changing from minus to plus signs is a necessary condition for better days, but not by itself a sufficient one. Acceleration requires momentum, and momentum is derived from conviction. The best days of 2017 never really had that. The absence, perhaps clearest in China, particularly the hollow rebound of the Chinese yuan, which somehow lacked capital inflows, a theme we'll keep coming back to. Everyone kept waiting for the Chinese to zoom on ahead and bring the whole up with them. Meanwhile, in China, they kept waiting for the rest of the world to take the lead so as to pull them up out of their funk. That's been the thing about global growth since 2011. Everyone expects that someone else will solve their economic problems for them. Momentum will arrive. You'll see it'll come from somewhere else. Without a clear path to that next step towards recoveries, doubts multiply rather than abate. What was for time mild opportunity reflation now sinks back towards the melee of liquidity risks that over time can only return to self-reinforcement. This is what's significant about China's numbers today. They practically declare reflation dead and gone. There is no upside left. What you saw in 2017 was the best of it. It wasn't very good. It was, in honest analysis, not really that much better than 2016 at all, certainly less than the prior peak. China's economy is not crashing. However, it is slowing, and from an already weakened level. The Chinese system will not actually recover from the last downturn, despite now 3 years' distance. What these numbers show is that, like the Eurodollar system, there is now very little chance that it ever will. It may not seem like much compared to a full-blown breakdown, but pretty conclusive evidence for a worldwide, multi-year, possibly decade, L-shaped recovery should be terrifying. A world without opportunity is a far more dangerous one than a world only temporarily stripped of it. The V can be scary, but only on the way down. The L is, well, I think we're going to find out about. If China's exports fall, the world's exports fall. China can't turn to consumption, as the U.S. has, because it has built an economy on low wages. That is slowly changing, but to accelerate it will entail killing the golden goose of exports. As a consequence, Chinese stocks, as represented by the Shanghai Composite, have dropped 30% below January highs. The spread between China's market and the rest of the world is growing alarmingly wide. Meanwhile, local government efforts to shore up confidence in smaller companies has failed to boost sentiment, while the yuan tumbled to 6.94, just shy of its 1.5-year low of 6.9587, touched in August, after the U.S. Treasury Department stopped short of declaring China a currency manipulator, a move that some interpret as giving Beijing breathing room to allow a weaker exchange rate. Equity markets are at their lowest since November 27, 2014, nearly 4 years ago. They are down 52% from last bubble peak of June 12, 2015. They are down 59% from all-time bubble peak of October 16, 2007. They are now back where they had first been on December 27, 2006, nearly 12 years ago. If Beijing keeps on presenting all of these growth numbers that look so solid, it's asking for it. Moreover, the party has lost control over the shadow banks, and it couldn't act to regain that control if it wanted to. It could initiate a program to forgive debt owed to national banks, but what's owed to the shadows will not be paid. We are talking many trillions of yuan here, dollars for that matter. We showed this credit impulse slide in our April Under the Lens video. It was a clear sign of problems ahead and of China's attempt to get its debt growth and leverage under control. This has not worked out, and it has now been forced to resort to stimulus and the rate of growth of credit to keep the system from more rapidly declining or potentially imploding. Expect this to accelerate much faster and highly likely to new highs. More than half of China's deleveraging was erased in Q1. China's non-financial corporate debt is rising again as a percentage of gross domestic product, following a year and a half of deleveraging from its mid-2016 record, according to new data from the Bank of International Settlements. The ratio jumped to 164.1% in the first quarter of 2018 from 160.3% in the first 3 months of 2017, erasing more than half the progress Chinese companies had made in reducing debt loads since the ratio topped out at 166.9% in the second quarter of 2016. That's the BIS data. The Bank of International Data published this on September 23rd, showing it. China's government is looking at ways to counter the effects of an ongoing trade dispute with the U.S., which is set to knock 0.5% off of Chinese GDP growth, at least according to Bloomberg's intelligence estimates. That may mean postponing its deleveraging ambitions, which now appear to have derailed even before the two countries began imposing tariffs on each other's exports earlier this year. The releveraging of the Chinese economy this year is being driven both by an acceleration in the pace of debt accumulation and a slowdown in economic growth, which will cause the debt ratio to rise. In 2017, faster GDP growth allowed the authorities space to operate tight monetary policies. As a result, debt growth slowed. That benign backdrop has now dissolved. As a result, the authorities are withdrawing from their tight stance. A majority of analysts now expect China's central bank to inject additional liquidity into the financial system in the final months of this year to support the economy as the outlook darkens, at least according to a Bloomberg survey. The government is also preparing measures on the fiscal side to boost domestic consumption and investment in the face of rising external risk, including tax cuts and infrastructure spending. At least Chinese officials told reporters that, quote, China is fully capable of hedging the impact by expanding domestic demand, end of quote. Despite already high levels of existing corporate debt, the government still has room to expand fiscal stimulus, though it may be accompanied by an increase in defaults. They claim right now it will be more about controlling leverage, they say. To that end, the required reserve ratio, or RRR, has again been cut, thereby further loosening monetary conditions. The liquidity easing policies are now becoming clearly evident. The problem is managing China's super leveraged debt, a number that I believe is something no one, including China, has a handle on. Whether shadow banking, local government borrowing and lending, wealth products, stock market margin usage, and more, it seems that debt is much, much higher than government statistics. There are hidden icebergs everywhere that seem to come to light almost daily. As Warren Buffett is well known to warn, you don't know who is swimming naked until the tide actually goes out. Just this month, the world discovered that we could add another 40% of debt to GDP to China's total debt because, according to S&P, China's local governments have accumulated $5.8 trillion, or even more, in off-balance sheet debt, suggesting an already record surge in defaults is set to accelerate further. The potential amount of debt is an iceberg with titanic credit risks. As written by S&P credit analysts in an alarming report recently, much of the buildup related to local government financing vehicles, which don't necessarily have the full financial backing of local governments themselves. LGFVs, or local government financing vehicles, debt has emerged as a growing risk for China's economy because with the national economy slowing and as a result of a crackdown on shadow lending and a Beijing quota for issuance of local government bonds, there is not enough to fund infrastructure projects to support regional growth. Therefore, authorities across the country have resorted to LGFVs to raise financing. That's left LGFVs walking a tightrope between deleveraging and transforming their businesses into more typical state-owned enterprises. Local governments have rushed to sell bonds but are short of new infrastructure projects. More than 40% of the new debt, in fact, now doesn't drive infrastructure growth. China's burst of local bond issuances to pay for infrastructure and support the flagging economy is being hampered by a lack of available projects and the negative effect it's having on private sector funding. Earlier this year, central government attempted to counter the economic slowdown by ordering the accelerated sale of special infrastructure bonds, and provincial authorities have responded enthusiastically. A flurry of sales in August and September means that 92% of the 1.35 trillion yuan, or $195 billion, target for this year has been sold by the end of the last month. However, about 42% of the total special bonds sold since August are earmarked for what they call land reserves, which means compensating farmers for acquisitions or preparing the acreage for future development, according to an analysis of bond data by Bloomberg News. In short, the economic boost of the debt creation will be less than if it was used to build highways or redevelop substandard housing. Land reserve bonds are favored because local officials don't have enough projects in the pipelines, as I said, when they're being asked to speed up spending. Land preparation isn't included in the calculation of fixed asset investment, meaning the biggest share of government special bonds, land reserve bonds, can't lift the headline investment growth number, analysts wrote in at least in a recent report I read. Policymakers decide an annual quota in March of each year. That has swollen over the years as local authorities grapple with worsening financial conditions as well as increasing downward pressures on the economy. The spending is seen by some as a turbocharger in boosting investment as it stays outside the official budget and can leverage additional bank loans and even private capital in infrastructure projects. Meanwhile, debt vulnerabilities continue to rise as a result of the previously reported record surge in Chinese corporate defaults this year, as Beijing seeks to roll back a decade-old practice of implicit guarantees for debt. According to the research firm Rotem Group, there have been already at least 14 corporate bond defaults in China in 2018, a shocking high number for a country which until recently had never seen a single corporate bankruptcy, and a number which is set to increase as Chinese banks pull back from lending to other firms that use the funds to buy bonds, exacerbating the pressure on the market. As part of Beijing's crackdown on China's $10 trillion shadow banking sector, strains had spread from high-yield trust products to corporate bonds as the lack of shadow funding has choked off refinancing for weaker borrowers. Separately, banks lending to other financial firms, a common route for funds and security brokers to add leverage for corporate bond investments, has continued to decline since reaching a peak at the start of 2018 and now down to the lowest level since late 2016. The deleveraging campaign is also depressing bond demand. Unlike the U.S., where the majority of bond buyers are mutual funds, individuals, and investment companies, in China, the key holders of the bonds are bank on and off balance sheet positions, according at least to work that UBS recently published, who noted that Chinese banks are buying far fewer bonds as a result. There is another reason why the traditional bond buyers have been missing from the market, according to a new report from Goldman. The threats to the Chinese bond market continue to rise, with 2018 shaping up as a record year for onshore bond defaults. There are additionally very serious concerns about pledging shares, in which major investors put up stock as collateral for personal loans, a disastrous practice when stock prices are dropping. This practice has emerged as a key pressure point for China's market, with rising fears of widespread margin calls, recently fueling a 3% tumble in the Shanghai Composite Index, which sank to a nearly 4-year low as more than 13 stocks fell for each that rose. There's effectively a liquidity crisis in the stock market, and pledged shares are again starting to sound the alarm. The fear is that if Beijing does nothing, the self-reinforcing liquidation is only set to get worse, with $603 billion of shares pledged as collateral for loans, or 11% of China's market capitalization. Traders are increasingly concerned that forced sellers will tip the market in a downward spiral. Actually, it reminds me of the kind of margin that was out of control prior to the 1929 stock market crash in the United States. This shows the IMF's prediction of the growing size and expectation of total Chinese debt. I have previously spelled out in Under the Lens videos how China does not inject liquidity and credit in the same manner as the rest of the world. This is because the People's Bank of China operates differently, and because the economy is a mixed economy. China is a quasi-capitalist system. This stems from the magnitude of control and central planning and state-owned enterprises that exist because of a still maintained foundation based on the Chinese Communist Party. The Communist Party has more authority than the government. In fact, it is still the government. We may all know this, but we tend to forget it or assume it is operating like Western developed nations. It doesn't. That is a big deal and needs to be understood when considering global liquidity formation and financial flows we are going to get into in this session. China's bond yields have fallen, making it less attractive in attracting capital, a cornerstone of China's economic growth. China's bank lending to other financial firms has dropped to the lowest since 2016 as the government tries to step into the breach. The new credit is not flowing fast enough, and the pace of the government reductions in the RRR has been accelerating, but it brings the problem of a falling currency into play. As Alhambra's Jeffrey Snyder recently noted, like 2015, these RRR cuts are showing us the euro-dollar condition. China's money problems aren't really Chinese. They are a global money problem. I wish I had time to get into this here, but I don't. I refer you to the great work Jeff is doing on this subject at Alhambra Investments. The slide in the yuan has become a concern for everyone on many fronts. We talked about this in our July Under the Lens video, Trade Wars, Win the Battle, Lose the War, which can be found in the Macro Analytics YouTube library. China is increasingly unable to attract vast amounts of capital it needs to keep the liquidity flowing. It has been steadily reducing its foreign exchange reserves in the form of selling U.S. treasuries, but this is not at all what it wants to do, at least currently. Gross fixed capital formation in China has been massive since it entered the World Trade Organization. This is the slide that is critical to appreciate and fully understand China. China's GDP is not about consumption as it is in the United States, nor is it about exports because of the size of its imports. It simply doesn't add significant value and presently is more or less a pass-through operation. China is about capital formation, capital either attracted as investment into China or domestically created. It is failing to do the former in sufficient fashion, and until recently was actually attempting to restrict credit growth. The problem has now become acute. As the comparison here shows, capital formation tracks the decay in the indicators I showed at the beginnings of this session. Not to diverge from our theme, but it's important to note that the yuan has actually been closely held to the price of gold, or vice versa, until recently. That peg has been broken, which I believe says something about both the Chinese problems as an accumulator of gold and the potential for gold itself. The problems China faces are both cyclical and structural, obviously. To put Chinese debt into perspective, this chart shows that total debt and annual GDP, each divided by the 0 to 24-year-old Chinese population. As of 2018, every child and young adult in China under the age of 25 is presently responsible for over $100,000 in debt, while the annual economic activity, GDP, created by all this debt continues to lag ever faster. And the coming decade only worsens as the young population continues its unabated fall and debt creation, absent co-commitment economic growth, continues soaring, building more capacity, all for a population that is set to collapse. China's predicament and reaction to it are not particularly unique, but given China's size, the ultimate global impact of China's slow-motion train wreck will be unprecedented, particularly as their 15 to 64-year-old population is now in indefinite decline. The chart shown here shows annual change in Chinese 15 to 64-year-old population in both millions, green column, and percentage, blue line. Massive overcapacity, thanks to over a decade of government-mandated malinvestment versus a ever swifter declining base of consumption, does not add up to a burgeoning middle class or a happy ending. I fully expect People's Bank of China to soon begin flooding the world with yuan. This could potentially trigger a temporary sugar high for world markets and effectively kick the can of global imbalances further down the road. I think the other central banks believe this is the only recourse for China's problem and hopefully for their own. The problem, as I laid out in our 2014 thesis paper, is the inevitability of the globalization trap, which is available as a full white paper at MAD-SII, and the globalization cycle, which I laid out recently in our August Under the Lens video. So in closing, as I always remind you, remember, the answer will be to print more money. It's the only answer politicians will ever agree on, and it will continue until no one wants it or trusts it. So invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2018 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.